So why didn't we panic this morning? Why did I say stay the course? First, I assessed what kind of sell-off this is. Do we have a problem that's systemic, meaning there's actual weakness in a rot in our institutions that can't easily be undone? Now, my partner David Faber and I discussed this very point this morning. We agreed that we needed to take the financial crisis scenario off the table because our institutions are strong. And look, we don't believe that the whole economic system is in jeopardy. We don't believe that major banks will fail. We definitely don't like the situation, for heaven's sake, and it's likely we're headed for recession because of the president's ill-advised plans. But we'll pull out of it one way or another. It's not going to be the global financial crisis number 2. And that's important because if you look at the 15% downturns we've experienced in the last 40 years, the vast majority of times you had to buy, not sell. Normally, when we're down 15%, we actually have seen the worst of it, or the market becomes viable again, unless it's systemic problems like the financial crisis. You have to assume that, yes, indeed, the worst may indeed be behind us. Second, you had to assess the proximate cause of what happened. In 2007, it was the massive leverage in the system affected a huge number of financial institutions. Now, but looking back at most 15% declines, the proximate causes were usually because the Federal Reserve tightened too much or there was a one-off event that eventually resolved itself. Right now, we're clearly looking at a one-off event, the president's decision to enact shockingly high, perhaps, let's just say, even dangerous high tariffs. As long as the tariffs stick, our economy is in real trouble. But it looks like the president doesn't care. He should always care, both short and long term. That's part of his job. That said, the stock market almost always bottoms before the economic indicators like employment, industrial production, GDP growth. Before they start rebounding, the market bottoms. I want to thank Michael Semblis, the unbelievably good strategist, J.P. Morgan, who actually pointed that out in a remarkable talk that was also had some humor to it that he gave today. He noted that the administration lacked rationality in the way it went about this very suboptimal plan. And while it hurt the economy, it's not the beginning of a nuclear spring. Thank you.
During Monday's hectic trading day, NVIDIA's shares saw rises. The company's share price ended the day up 3.5% after peaking at 7.9% during the day. However, during the day's trading, the stock had also dropped as high as 8.2%. As investors responded to new tariff news, the stock market experienced extraordinary volatility today. Despite starting the day trading sharply lower, most indices were able to rebound as the day went on. The Nasdaq Composite actually managed to conclude the day up 0.1%. While the S&P 500 index closed the day down 0.3%. Investors' reactions to President Trump's remarks regarding the possibility of further tariffs on China caused significant sell-offs in NVIDIA and other growth-dependent tech firms early in the day. The president threatened to impose an additional 50% tariff on Chinese goods in a statement posted to Truth Social, unless the nation removed a new 34% import tax that it had put in place in response to a matching tariff move from the United States. A claim that the Trump administration was proposing a 90-day halt on the introduction of additional tariffs for all countries except China caused the market to briefly soar. However, the White House refuted the news, which was not verifiable. Stocks were able to recover on the news that tariff talks with certain nations might be underway, despite sell-offs following the denial of the report's substance. Forecasting NVIDIA's future is extremely challenging due to macroeconomic uncertainties. Despite the fact that semiconductors seem to be exempt from the new tariffs that are about to be implemented, the uncertainty surrounding the status of the economy may cause the company's big clients to cut down on their expenditure. NVIDIA's stock is expected to be very volatile until investors have a clearer understanding of what to anticipate in terms of tariffs, inflation, and the outlook for global GDP. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Start with you. So much concern about tech. Someone like Dan Ives has said this has set us back a decade. He certainly seemed extremely he was disconcerted on Friday about what this means. In the meantime, I'm seeing Apple here, some notes that Apple will change some of its production over to India, where there's half the tariffs that there are in China. What do you make of it all?
Well, I mean, this is at this moment, this is kind of the fog of the global trade war. And if companies are changing their behaviors to where they're producing, what they're doing, and how they're doing, that's exactly what the Trump administration was wanting to have happen. Either countries are going to negotiate on tariffs and do the foreign policy things that he's looking for and economic policy things he's looking for, or companies are going to be encouraged to move to other countries where they are. So the problem is time. Everybody is, the decision-making process is very, very truncated, but the implementation process takes a while. And I think that is what this push me, pull you that's going on in the markets. How quickly can people and countries and everybody adjust? So I'm not near as negative on this as Dan Ives is. I think that basically companies are going to adjust. And more importantly, you have a lot of countries that are beginning to say, yes, we'll begin to negotiate. And I think that was the administration's target.
All right, Young Yu Ma, good to see you. Glad you're here. Of BMO, thank you for being here. Your thoughts on the tech sector? There are folks who are seeing it beaten down and say maybe there's opportunity here. What say you?
Thanks. It's great to be here. I think a lot of the drivers that were in place prior to the tariffs will still be in place and ultimately be the dominant force after a lot of this shakes out. I do think there are some bargains to be had, but I think there are a few questions now, given this new tariff regime, is one, which companies have potential to see profit margins squeeze or more difficulty in terms of whether it's shifting production or geographies in terms of where they generate their profits. If that is at risk, I think there is a new calculus at hand. But overall, the major trends are going to stay largely the way they were. And we do think that the first wave of the selling in the tech sector was everything goes down. And the second wave is some of the more stronger names, which we'll probably see during earnings season, start to stabilize and hold up a lot better. So I do think there are bargains to be had, but that doesn't mean right now it's wholesale bargains out there.
So what kind of names would you be buying? Let's go over that. I mean, there are names that may be most exposed to tariffs that you want to stay away from and others that may be best positioned. Dryden, what would you maybe buy today or you're watching to buy soon?
Sure. We're looking at companies that are least affected by tariffs. I mean, the entire market was taken down by this. Everybody kind of threw the baby out with the bathwater as what we believe is an overreaction. And so when you look at companies like Meta, we have a forward PE of 20. They basically get 44% of their revenues within the United States. Or you look at Salesforce with a PE of 22 now, where they're getting significant revenues in the United States, and even Google. So companies that have a lot of their revenues in the United States that are more in this software realm and area, they are going to be least affected by these tariffs. And so they've been most affected by the overreaction. They'll be least affected by the tariffs. And so we think that there's opportunities in this. We've always said you want to take advantage of volatility and not be its victim.
Yeah, and Young Yu, what would you say? Are there names that you like that may have potential opportunities, or on the other side, the ones that are so much exposed that you wouldn't touch it?
Well, I think the advice you just heard is very sound advice, that thinking about the names, I don't do individual stock picking, but thinking about the names that fit that profile, that are more exposed to the U.S., that are not likely to have margins shrunk in terms of what they're importing, that tend to be software focused or have intellectual property that is very robust and has a big moat around it. I think those are the names that you want to look for. The ones that could be subject to tariffs, perhaps rely on China more, perhaps would have profit margins squeezed due to tariffs and a shifting regime where they might have to shift production around, and it's uncertain how much of those new costs could be passed on to consumers. I think that's where you want to be more cautious here. That doesn't mean that bargains can't eventually show up, but probably the first wave where everything goes down, you want to look at those things that are actually going to be least affected in this new environment.
Yeah, and you mentioned, by the way, Dryden, thank you for that, Young Yu. You mentioned Meta, Salesforce, Google as your picks. Also things that are in the software realm. Anything hardware? You're just waiting to see on that.
I think you have to wait on the hardware, because right now we're waiting for negotiations to take place. Who's going to come to the table first? What's going to actually happen? So the math is very foggy at this moment. So I think you have to wait a little bit on hardware, but I think we're probably in a period of time where fairly soon you're going to see some key responses from either the White House or the various countries. I mean, I think there is a trade war. China's the target. That's the primary enemy. So I think you have to look at things that are not going to be heavily affected by China. Those are the things that will probably recover more quickly, and those that are based within the United States.
Concerns that President Donald Trump's import tariffs may reduce their earnings have caused stocks in a variety of businesses to fall precipitously in recent days. The United States has unveiled a plan to slap tariffs at varying levels on the majority of international imports. However, the technology sector's stocks have been most affected by the news. This is due to the fact that many businesses import components and even completed goods from overseas as part of their cost models, and taxes on these imports will raise their costs. Because of this, some of the top performers in the stock market from the previous year are now on sale lists rather than buy lists for many investors. NVIDIA is a prime example. Only a few months ago, investors hoped to purchase the business at a discount. NVIDIA has achieved remarkable revenue growth by establishing a leading position in artificial intelligence, AI, one of the fastest growing areas. NVIDIA has achieved the bargain levels that investors have always dreamed of because of the current shift in market attitude toward tech giants. Is it time to purchase this leading AI stock at a discount? Let's start with a brief overview of NVIDIA's current trajectory. The company offers a variety of AI products and services, in addition to the most potent graphics processing units, GPUs, in the world, which are the processors that drive important AI operations. Selling processors to the gaming sector is another profitable area for NVIDIA. Due to all of this, the internet behemoth's revenue has increased by double and triple digits to reach all-time highs. In the most recent full year, it reached $130 billion. Investors have been drawn to NVIDIA because of its dominant position in the AI chip market and proof that the AI industry is still expanding. For example, while infrastructure is still in its early phases of development, IT behemoths are spending billions of dollars on AI. Meta Platforms estimates that it will spend as much as $65 billion this year. Analysts predict that the AI sector as a whole will surpass $1 trillion later this decade. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now, let's dive into today's video.
I want to bring in now Jim Paulson. Jim, listen, we've already seen wild gyrations today, suggesting that this market is like a coiled spring, but on the other hand, obviously it's still vulnerable until some sort of deal is done. What are your thoughts?
Well, I think, we've really had a shock, and it's going to take a while now to stabilize, Charles, and to trend higher again at some point. But I think the worst might be over. I'm not saying we won't maybe set a marginal new low, and we certainly are going to face volatility for next few weeks, if not in a couple months. But I also think some good things have happened here with this latest collapse. We've dramatically improved valuations. The S&P PE multiple on a trailing basis now is the same place today as it was at the start of in early 2023, really near the start of the last this bull market, or right after the pandemic collapse. So early in that bull market, we've improved the concentration that was in this market with Mag 7 and tech stocks. I think the Mag 7 has lost $5 trillion in value. Their weighting's gone from like 35% down to 30% or something. That's a big improvement. We've certainly improved sentiment, Charles. We had people that said they were pessimistic even this time last week, but they weren't doing anything about it. They still had high equity positions and low cash levels. But now we've seen that change. With the panic, we're going to see people that have totally left the market. We're going to see cash levels on the sidelines go up. We saw the put-call ratio spike. Right. We saw the VIX spike. And lastly, I just say, we've actually had quite a bit of policy support. Long-term bond yields have come down. Commodity prices have come down. The dollar's come down. All of those are stimulant forces that help ultimately to bottom this thing out.
You were on a show about a month or two ago, and the market was under a lot of pressure, and you said we hadn't seen classic capitulation. I thought you were kind of nuts, but it turns out, you were right. And then the other part of this, and I'm glad you brought it up, some of the classic contrarian buy signals, whether it comes from, the sort of the VIX and that big spike in the VIX, or we look here at some of the cyclical defensive drawdowns, obviously they're all out there. If this is any other time, many on Wall Street would be thinking, hey, this might be the time to buy the dip. Instead, we're getting a whole lot of firms saying, lowering their targets and looking for an exit.
I think that's good news. That's what I guess my point is. I see that final panic capitulation. I mean, a week ago, the talk was still, is it a good time to buy the dip? Now it is, get me the hell out, basically, is what the sentiment is. And you are seeing target prices being dropped for the year, earnings estimates being dropped, the whole gamut. I think it's good to buy in times of fear like this. This is when the risk is probably less and the upside is greater. When sentiment becomes this dour, even additional bad news might turn out to be better than what people fear.
Right.
And good news will be a real shocker, which could really bring a bid back into the marketplace.
All right, so last week, another leg that was kicked out from under the market was Jay Powell. Now, I'm not sure if the street was expecting too much, but certainly when Jay Powell, said, listen, we're going to have this, this thing, and everyone's sort of hoping he would, because he mentioned transitory in the FOMC gathering. He didn't mention it last week, but I do think this is interesting. Everyone's talking inflation. I went back, I looked at Smoot-Hawley. Inflation wasn't a problem. The market has come down a lot, but the five-year forward break-evens, they're down dramatically. This is not saying inflation. Should we be bracing for inflation, and where does this put the Fed?
I don't understand the Fed's argument worried at all about inflation right now, Charles. A tariff is a tax by any other name. And if we had just gone through a situation where President Trump raised taxes on all global output, no one would be saying that we're at risk of inflation. They'd all be saying we're at risk of recession and disinflation, maybe deflation. If I look at every financial market, bond yields, and as you said, break-evens collapsing, they're saying deflation's our problem. If you look at commodity markets today, they're all collapsing. They're saying deflation's a problem. Credit spreads are blowing out. They're saying deflation's a problem. The dollar's coming down, saying deflation is the problem. All of the financial markets are screaming for the Fed to ease, and I think they're going to have to. I think in the next few weeks they're going to be forced to start to ease. We've only had 4 other episodes in World War II history where the market fell 10% in 2 days. That was in 1987 in the Great Market Crash, in 2001 .com, in 2008 Great Financial Crisis, and in the 2020 pandemic. In every one of those previous instances, the Fed eased almost instantaneously. I don't know why the Fed is waiting, but I think they're going to lose the argument. There are only a couple bad unemployment claim numbers, a further drop in commodity price numbers away from having to ease, and I think they're going to pretty soon. Yeah,
and Jim, to your point, 87, you had a brand new Fed chair, and Alan Greenspan, he came in, he saved the day, and he actually, I think, set up the blueprint for future Fed chairpersons to come in there and do what they had to do. And of course, it was always to rescue the market. Hey, Jim, I'm really glad to start the weekend, this day off with you. Thanks so much, my friend. Appreciate it.
You bet. Thanks for having me, Charles.
See you soon.
I'll now talk about the news that has been affecting NVIDIA and the IT sector as a whole. As previously stated, Trump has levied import taxes on nations all around the world. This could be detrimental to foreign nations since it might deter American businesses from importing items and encourage them to create their own domestically. However, in the case of technology, their cost structures rely on production in certain nations that provide businesses with cheaper costs, as well as the infrastructure and knowledge required for specific tech products. The majority of NVIDIA's manufacturing is carried out in Taiwan, despite the fact that it is a client of Taiwan Semiconductor Manufacturing's recently constructed Arizona facility. NVIDIA's Blackwell chip will be produced in Arizona by TSMC, which has been making significant investments in its U.S. footprint. However, the product will still need to be packaged in Taiwan. The capability required to execute the task is not present in the U.S. facility. Because of all of this, NVIDIA continues to import a lot from Taiwan and is now subject to the 32% tariff that the United States has placed on that nation. This additional charge will undoubtedly affect NVIDIA's earnings if the company is unable to make up for it by reducing costs elsewhere, and the United States keeps the tariff level at its current level. It goes without saying that NVIDIA is not the only American tech company facing this challenge. Should you purchase NVIDIA stock in light of the recent drops in share prices? It's especially crucial to consider the situation from a long-term perspective during times like these. However, NVIDIA will suffer some harm if the tariff scenario doesn't alter. It's crucial to remember that NVIDIA wants to increase production in the United States and might be considering various strategies to lessen adverse effects. Over the years, CEO Jensen Huang has demonstrated his capacity for initiative by staying one step ahead of rivals and breaking new ground in rapidly expanding fields like artificial intelligence. He has also managed crises, such as technology export restrictions to China. In order to adhere to export control regulations, he oversaw the creation of a new chip for that market. All of this indicates that despite pressure on the company in the short term, there is cause for optimism regarding NVIDIA's capacity to handle the current crisis and increase profitability in the long run. Earlier this year, the stock was trading at 50x projected earnings estimates. Now it is trading for 20x. Even with the tariff backdrop, it appears to be a great deal at that pricing when you take into account all of the advantages I have listed. One significant opportunity in the midst of the tech sell-off is the possibility to purchase NVIDIA at a discount and hang on to it for the long haul. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
So, Kevin, I'm taking a look at the S&P 500 right now, decidedly lower. Every sector back in the red aside from comm services, although at least not at the lowest levels of the day. We've been all over the place. So what levels are you looking at for the S&P 500 going into the close?
Yeah, I mean, if we close here, being down 0.6%, feels like we're flat on the session, to say the least here. I think the market's really trying to decide what the president's really going to say. He is actually making some remarks right now, so you're seeing a little bit of a holding pattern when it comes to the price action here. But if I'm kind of looking at going into the close, you have some pen risk at 5,000, at that 5,000 level. There's a significant amount of options positioning there just across all of the major expirations, a lot of the quarterlies, as well as even the April expiration that's going to expire next week. And so we might have a little bit of pen risk there. If we do get some positive energy to the market, so we try to bounce to the upside, I'm looking at 5150 to around 5200. We highlighted 5200 earlier this morning. We broke through it briefly and then faded back. But that could be an area to the upside here. And then to the downside, 4950. Caroline, the one thing that I would just put out there as far as risk, I mean, we had this announcement from President Trump, and he just confirmed it in this press conference right now regarding increasing those China tariffs by 50% if these retaliatory tariffs from China are not removed by tomorrow. And it doesn't appear that the market is really taking that threat too seriously. So that is actually a really big potential downside risk, not only to equities, but also potentially a re-rating when it comes to yields here. So let's see how the market actually positions going into the close. We've been trying to push higher. Mega cap tech has been kind of leading the way anytime that we had this push to the upside here. But I would just put it on the radar for a lot of individuals. Next 24 to 48 hours, we actually have probably even bigger risk than the first China announcement that we had. If they do come back and retaliate again, the market is not pricing that in whatsoever.
All right, so I want to talk to you about what that could mean in terms of volatility and the VIX. I do want to just say I'm taking a look at the Reuters headlines from what President Trump is saying. And as you said, he did talk about China. He says, we will talk to China. I have a great relationship with Xi. Hope it stays that way. In terms of that 90-day pause, which they called fake news, according to CNBC, he did say we are not looking at a 90-day pause. And he also says tariffs could be permanent and could also be talks. So basically not learning a whole lot from here. So if it could be riskier over the next 2 days or so, what are we seeing in terms of volatility in the market, and what could we see?
Well, volatility, if you're looking at the VIX, is still elevated. We're still sitting at around a 47, about a 48 VIX. That's implying around a 3% intraday move to the upside or downside. And you're seeing that reflected also in the S&P options, not only on the wings, which is really what the VIX is being priced off of, but also when you're looking at the money calls and puts. And unfortunately, that is actually driving options volume on the index level. If you're looking at the NDX, if you're looking at the Russell or the S&P 500, to drop dramatically. Last time that I checked before coming on here, the top traded contract today is only sitting at around 39,000 contracts being traded. That's the 5,200 calls. Caroline, at this point in time, usually we're sitting at around 78,000, maybe even close to 100,000 contracts being traded. So you're seeing about half of that volume, even maybe 60%, 30% of the average volume that we usually see. So it will compress trading activity on the index level, but even though the individual equities, we're probably still seeing a lot of options flow that is there. But VIX is at a very extreme range. We're talking about a 6 to 7 standard deviation move to the upside. It can stay elevated for some time. Back in 2008, the VIX was elevated for almost a month and a half or so before actually moving back to the downside. But if you're a bull, you want to actually start seeing us incrementally moving lower here when it comes to the VIX, and hopefully that's going to provide equities a little bit more of a boost to the upside here. But if China does respond and they respond in a negative way, we could actually see a pretty significant blowout of the VIX to the upside. And I'm talking 60 level, 70 level type of blowout.